This mainly comes from this review chapter that's forthcoming in the handbook, the Economics and Finance, but also a bunch of recent stuff, different working papers and book chapters and things, and then one kind of older one, which is Ken, 2002. And what I hope to do is 4 things. First, I want to tell you everything you need to know about alpha. And then I want to talk about the role of benchmarks in performance measurement. It's a crucial thing because every time we do investment performance measurement, we're always comparing a fund with some benchmark. Always. So I want to be a little more explicit about what that means and how it works. And I want to talk about Sharpe ratios, one measure that many people have used, but where I think I want to tell you some stuff about Sharpe ratios that you may not appreciate. They're actually potentially better than you think. But I want to focus mainly on number 4, which is holdings-based measures of performance, because I think really that's where the literature is going right now, and so it deserves the most attention. Okay, so everything you need to know about alpha, and I have 3 points to make here. First point is the traditional alphas that we all know and love are not to be trusted. And the second point is if you want to do an alpha that you can trust, then what you need to do is use the stochastic discount factor version of the alpha. And then the question is, well, are there cases when the traditional alpha can be trusted? And the answer is yes, and that is when they are equivalent to the stochastic discount factor alpha. And I'll describe the conditions when that's true. Okay. Everybody knows about alpha, right? How many people have never written a paper with the word alpha in it? Nobody. We all know about alpha, right? You use kappa M alpha, 3-factor alpha, 4-factor alpha, DGTW alpha sometimes. Hardly even feel the need to define it for the reader. We have this easy familiarity with it, right? So even practitioners in the business press think they know what alpha is. So a few years back, I went through the literature and I asked 2 basic questions about alpha. First question is, if you see a positive alpha, does it really mean that you should buy? Pretty basic question. And the second question was, if you have a manager who really knows stuff, who has superior information, will they generate a positive alpha as traditionally measured? So I scoured through this old literature, going back to the 70s and the 60s and the 80s and the 90s, and it was a lot of fun. It took a long time. And I'll tell you what I learned. Well, on the first question, does a positive alpha mean buy? There is a limited case where you could say that might be true. And, I've taught this to MBAs and undergrads, and I bet most of you have too if you teach investments or basic finance. And that's the mean-variance case, where you tell the students, look, if you have a portfolio or a firm in a capital budgeting context, and you find a fund, an investment, or a project that has a positive alpha relative to that, then what that means is you can, there exists some combination of the 2 that has a higher Sharpe ratio than the benchmark or the firm that you started with. And this is kind of a picture that we all draw and teach and stuff, right? Well, that comes from Dibrig and Ross, 1985, theorem in their paper. And it's true as a comparative statics, right, at the margin. But if you're actually going to make a discrete adjustment to your portfolio, it's not necessarily true. In fact, there's an example in this famous paper by Shanken, Ross, Gibbons, Ross, and Shanken, Econometrica 1989, where they say, all right, so let's start from the market index. It's not efficient. It doesn't have the highest Sharpe ratio. We have these small stocks that have positive alphas relative to the market. And then you ask the question, what portfolio would you make to get you to the frontier to be efficient? And it actually has short positions in the small stocks. All right, so you know, when there's correlation and you make a discrete change, even in that most simple basic case, you can't say that a positive alpha, as traditionally measured, means you should buy. Now, in performance measurement, differential information is at the core because it makes sense to imagine that the fund manager might know more about returns than the client investor. So in that case, you know, things get even crazier. So in general, I think Chen and Knez was one of the first on this. What happens is if the manager has more information, they can trade with more information. They sort of expand the opportunity set of the investor client without that information. So in general, the client would want to use that portfolio. The problem is they might want to short it even if it has a positive alpha. And that's Chen and Knez show examples of that. Now, but it gets a lot worse because there are a bunch of examples in the literature where you can have positive or negative alpha with neutral performance. All right? So if you have options going on, nonlinearities, if you have different information from the manager and the client's perspective, you don't account for public information, if you have the possibility that managers can trade faster than the interval where you measure returns, all these things can cause that situation. Neutral performance, but you can have either a positive or a negative alpha. And finally, Vince Glode comes up recently and argues, you know, you might even want to buy a fund with a negative alpha. He has a little model, an example, that shows that. So, you know, you look back at that old literature and you say, it says traditional alphas are not to be trusted as a normative guide to portfolio allocation. On the second question, this is even harder, which is if a manager has superior information, can you show that they would actually behave as to generate a positive alpha, as traditionally measured? And you look through that old literature, and this is where it gets really fun and that kind of confusing, the way these older papers wrote about stuff. But you find Mayers and Rice try to say yes, Dibrig and Ingersoll said no, because you assume quadratic utility together with complete markets, and that's crazy because it means negative prices of some positive payoff securities, because quadratic utility in extreme states starts throwing money away. That doesn't make sense. Marakian comes back with a counterexample that says the informed manager might not even get a higher return optimally. You know, it depends on other things going on. Connor and Parachik try to say yes, a really nice attempt at that using APT. Rimbaud and Tippett say no, but if you use the positive period measure, yes, no, yes, no, yes, no. This literature struggles. They put together these Byzantine combinations of assumptions to try to generate a positive result. They struggle with it, but it doesn't work that well. And then what happens is in about the late 90s, the whole literature that asked that question just dies. Now, I have a theory for why it died. That was about the time that the Fama French factors took over the world, So we didn't even have a theory then in which we could ask simple questions like that. So it just died. So you go through all that and you say, wow, I mean, what justifies this easy familiarity that we all have with alpha? We all use it as if it meant something. What's the justification? I don't find it. However, if we do it right, and this is from a working paper with Chair Lin, we can justify alpha. We can have a version of alpha that actually works. And we show that in this paper. So basically, what you want to do is you want to think of this Euler equation for your client, say, who has a marginal rate substitution, red M, the price of all the underlying securities for which that client is at an optimum and happy. If the client is happy with their allocation to these assets, that Euler equation has to be satisfied. Okay? And the client may have their own information, Z. And if you define the alpha as the deviation from that Euler equation for a fund, if you introduce to that client who is happy, and then suddenly you show him this fund, and if you define alpha as, does that fund cause the first order condition to deviate, as on that last line, then what we can show is, if a client sees a positive alpha, he would want to buy. All right? So, briefly, it's a multi-period, sort of a discrete time version of a Merton-style model. So it's pretty general. You don't have to assume, normality or all these crazy assumptions that this earlier literature had to assume. We imagine the client has this information Z, and the manager may have more information than that, and maybe. And we define the alpha that way, where the M now is defined with the marginal utility of wealth, the future wealth, through the value function, defines the M. And basically, we put in that model, we start a client off happy with the situation, introduce a new fund that generates a positive alpha, learn about this new fund, what are we going to do, and then we show that the amount, delta, that the client would buy is proportional to the alpha, measured through the stochastic discount factor. So the right alpha works. That A, now I have to assume something, and this isn't real theory, because a real theorist wouldn't like this, because I have to assume that this thing Q is positive to get that result. And what that Q thing is it's almost something squared. If for example, the portfolio weight response in the other assets, one of the earlier literature had to assume that's zero sometimes. If that was linear or close enough to linear, then that would be something squared. So I think that's probably almost always going to be true. And then we have this result, pretty general, that the right alpha does mean you would want to buy. So, okay, that's cool. A special case of this is this Yesman Brown et al. Manipulation proof measure. It's a special case. So, if traditional alphas are not to be trusted, but the right stochastic discount factor alpha is to be trusted, it's pretty obvious what the answer to the question at the bottom is. When can traditional alphas be trusted? Are there situations? Yes. If they are equivalent to the stochastic discount factor alpha, then they can be trusted. All right? So when are they going to be equivalent? Well, this has to do with the benchmark. So the traditional alpha is always return minus benchmark. Expected return minus benchmark. Expected return, always. And so I'll just remind you of that with a couple of simple examples. And then what I'm going to do is I'll talk about this concept called an appropriate benchmark, which is, and the result's going to be, if you use an appropriate benchmark, then your traditional alpha is going to be equivalent to the stochastic discount factor alpha, and you're going to be okay. Okay? And then I'll talk about mean variance efficiency in benchmarks, and I'm going to argue there that a mean variance efficient benchmark is almost never an appropriate benchmark. And that may seem weird because the literature, somehow in the literature here, it was because of the CAPM, I guess, and we were just, our field was just kind of learning how this stuff works back in those days. And so there was this association between efficiency and benchmarks. So a lot of these earlier studies, I made this mistake myself once. Thought, okay, well, the benchmark should be mean variance efficient. Well, it's not even close. And I'll argue that's why that's true. Okay, so traditional alpha is always return minus benchmark. So here it's expected return given the client's information. Do it that way all the time. And, examples. So suppose we have the cap limit. We have Jensen's alpha. Then the benchmark, and you probably taught this if you teach investments, is essentially a combination of the market and the risk-free asset, with the weights in that portfolio chosen so that the fund has the same beta as the benchmark portfolio that you form. And the way you do that is to use the beta as the weight on the market, the fund's beta. Right? So then that portfolio will have the same market beta as the fund, and so it'll be equivalent in the sense of having the same risk to the fund, and so you'll just compare the portfolio to that benchmark. And you will have adjusted for the risk in the CAPM that matters, which is the market beta. Okay? And another example, of course, you can do a multi-factor version of that if you want to use Farmer French or Carhart factors. And then you have sort of loadings on those factors too, and it's the same thing, right? Then you just make a portfolio that is the sum of the fund's betas form the weights, and then 1 minus the sum of those goes into risk-free. And then that would have the same betas on all those factors as the fund. And that's the benchmark. And of course, all those kinds are the same thing as the intercepts in excess return regressions of the fund on those factors. Exactly the same thing. Right? So that's our familiar alpha that we all know about. Right? Conditional version of that, Rudy Schad and I wrote about way back in '96, is we introduced this excess return on the market multiplied by lag Z, public information, the client's information. And then we're modeling the beta of the fund as a time-varying function, conditional on the information Z. Okay? So in that case, it's the same thing. There's a benchmark. And in this case, the benchmark, I written on next to the last line there, it's the market and the risk-free, but now the weight in the market is a linear function of the conditioning information. So we have a time-varying benchmark strategy, if you will. It combines the market and the risk-free with time-varying weights, and those time-varying weights use the public information, and they do it in just the right way so that the conditional beta at each point in time of that benchmark is the same as that of the fund. It's the same idea, but you just allow everything to vary through time. Okay? So that's always what you end up doing when you do a traditional alpha. Okay? So the question is, when is that okay? When does that give you an alpha that can be trusted, that is, it's equivalent to the stochastic discount factor? And the answer is when the benchmark is what I'm going to call an appropriate benchmark. Okay, so the algebra numbers there, you just say, okay, stochastic discount factor alpha is the right thing. When is that equivalent to return minus benchmark? All right? You do a little algebra, and you see that the right alpha is E of m given z times the traditional alpha. Now, E of m given z is just like the risk-free rate. So that's the same for all the funds, and that doesn't really affect anything. That just translates the whole analysis from the beginning to the end of the period. You know, the traditional alpha, we measure return minus benchmark, and so that's measured at the end of the period. And in stochastic discount factor alpha, we measure alpha like a price at the beginning of the period. And so this E of m given z just translates through time. That's all. It doesn't really do much. So basically, if the covariance in red is 0, then you have a situation where your traditional alpha is equivalent to the stochastic discount factor alpha and can be trusted. So that's when that's true, when that red covariance is 0, that says that the covariance between the benchmark and the stochastic discount factor matches the covariance of the fund with the stochastic discount factor. And that's what I define as an appropriate benchmark. All right, the intuition is pretty simple because since the stochastic discount factor defines all the risk that really matters to the client, then these two, the benchmark and the fund, are equivalent on a risk basis. Right? Now, this is a special case of something that George Aragon and I wrote about, which we call the otherwise equivalent portfolio, which is broader because it includes things that these simple models ignore, like taxes. You know, is it equivalent to the client after you consider taxes as well, and stuff like that. Okay, so that's the appropriate benchmark, same covariance. Now, I'm going to argue that mean variance efficient benchmarks are almost never appropriate benchmarks. So this is kind of an algebraic argument. And so there it is. And it says, okay, suppose you had a benchmark that was minimum variance efficient. Well, what does that mean? Well, that means it has the maximum squared correlation with the stochastic discount. And said Richard, so if you regress M on the benchmark, what that says is that the error term would be uncorrelated with all the asset returns. Why is that? See, if the error term was correlated with some asset returns, you could throw those asset returns in the regression, and you could increase the R-squared. That would contradict the assumption that the benchmark has the maximum squared correlation, or R-squared. So that would have to be true. And so if you have an appropriate benchmark that is also minimum variance efficient, it follows that that red covariance there has to be 0. So it says the covariance of the fund with the residual in that regression has to be 0 if those two things hold. Minimum variance efficient benchmark and appropriate. Okay? But I'm going to claim that covariance just can't be 0. Well, almost never. So, I mean, if that covariance is 0, there's two possibilities. One is the benchmark is minimum variance efficient in the set of assets that includes the fund. In that case, as Dick Roll emphasized, all the alphas would be 0 anyway, and we wouldn't learn anything about it. So that's not very useful. The other possibility is that that error term in that regression is identically 0. Now that could work. All right? So that says that M is exactly linear. Sorry, affine. Affine. Because of A. In the benchmark. All right? But if that's true, remember, M is like marginal utility. All right? So that would say the utility function is quadratic in the benchmark. So only in that situation, the cap M is that situation. Only in that situation can a mean variance efficient portfolio be appropriate. And quadratic utility is not that appealing. It has increasing absolute risk aversion. It has a bliss point. It starts throwing money away. And maybe Bill Gates has reached these quadratic, he's reached these bliss points. I don't know. But it's not very compelling. Okay, Sharpe ratios. I'll just review quickly some of the traditional views about Sharpe ratios. And I'm going to argue that, well, wait a minute, Sharpe ratios really can be useful in performance measurement. Well, okay, there's the Sharpe ratio. Expected excess return on the portfolio divided by standard deviation. So traditionally we say stuff like, Sharpe ratio, you really shouldn't use it to evaluate a single fund because it ignores diversification. If you're going to combine that in a portfolio, what about the correlation of that fund with all the other stuff in the portfolio? Sharpe ratio seems to ignore that. Right? Then we should use it for the investor's whole portfolio if they're mean variance, see if it's maximized. But other than that, it doesn't make much sense. All these papers, Leland gets cited a lot, Andy Lowe more recently. If returns are non-normal, it might be inappropriate. Leland says, mean and variance is not enough. When there's non-normality and higher moments, you have to have higher moments of the utility function to get it right. So Sharpe ratio, not useful. Still, it's all over the place. In practice, hedge funds love it. They seem to be able to get really high ones through various means. But, you still see it used a lot. So I'm going to argue it's okay. And here's when it's okay. It's okay to use the Sharpe ratio if what you do with it for a fund is to compare the Sharpe ratio of the fund to that of an appropriate benchmark. Right? If you do that, then it turns out, as the algebra here shows, that the Sharpe ratio of the fund is bigger than the Sharpe ratio of the appropriate benchmark if and only if the alpha measured relative to that benchmark is positive. And if that's an appropriate benchmark, we know that's equivalent to the right stochastic discount factor alpha being positive. And we know that that means the client would really want to buy. So in that case, Sharpe ratios can be useful. Okay? And the algebra is pretty simple. He says, well, Sharpe ratio of the fund bigger than that of the appropriate benchmark. By the fact that the correlation is less than 1, there's an inequality there, which says that the alpha in that regression that defines the alpha relative to the benchmark has to be positive. So, Sharpe ratios can be useful. Okay, now how am I doing on time? Somebody have the time?
Yeah, 45 minutes.
All right, 45 minutes. Now, I want to use most of it on this holdings-based stuff. Where it all started, Roulette-Tidman. Conditional weight-based measures, this is where Ken Kong comes in. Our decade-old paper. Can you believe that was 10 years ago we did that? So you don't even look a day older. I look like an old man down here. Can you believe that guy actually has kids in college? He looks like he just got out of college. So conditional weight-based measures, other holdings-based measures, and then I'm going to say, all right, fundamentally, how should we do holdings-based measures based on first principles? And I'm going to observe that that's not how the literature has been doing it. So literature has been doing it wrong, fundamentally. Okay, except there are special cases, where it's equivalent to doing it right. And then I'm going to have some suggestions how to do it right. And I actually have a working paper on this, pretty excited about, where we're trying to do it right, as an example of that. And I'll mention that. Okay, so like I said, this is where the literature is going. So this is just a few of the papers since Griblatt-Tittman kicked that off. And so it's really, and the reason for this is, I think, is thanks to words. I was at the doctoral consortium yesterday, and they were one of the sponsors. And I told the guy, Paul, who started off Words, the Wharton data service, he said, you guys pretty much created this literature with Russ Wormer's help, by putting up this MSF links thing, where you can take the holdings data and link it to the mutual fund data. And this is what you have to do this kind of work. And so now it's so easy, everybody can do it. Doctoral students do it as a first-year summer exercise now, among other things. So it's easy to do. And so it's just exploded, this whole holdings-based literature. And it all started with Griblatt-Tittman back in the late 80s, early 90s. And they defined this measure, GT. So here X is the manager's holdings, or portfolio weights. And I have this omega, which is to say the manager may have information, omega, which is better than that of the client. And so they say covariance between the weight and the future return, and then sum that up across all the holdings. And they show, they have a model, and they say they assume normality and non-increasing absolute risk aversion, and they show that a manager who has omega will generate a positive measure under those conditions. That's nice. It gives you some theoretical justification, right? And of course, there's sort of two ways you can implement this. Is you could measure that covariance by demeaning the weights with a benchmark weight, which is what Griblatt-Tittman did. Or you can demean the returns and use the expectation of that product to get the covariance. And some studies have done that. Ken and I did that. And these measures have lots of advantages. They use more data than returns-based measures. They use the holdings data. They avoid these problems of nonlinearity. You see, you can have nonlinearity in returns. For example, Karachek and all, if you, Jagannath and Karachek, if you held options, you'd have an option-like return on your fund. And to a traditional measure of timing, that would look like timing. Because it would look like, high beta when the market goes up, went in the market when it went up, low beta when the market went down, you got out of the market when the market was going down. So it would look like timing, fake timing, right? But it's just nonlinearity from the underlying, the underlying stuff, and the weight-based measure isn't subject to that problem. It also avoids, and this is something I'll show you some numbers on this in a minute. Interim trading bias. This is also, this is what Getzman et al. In their 2007 RFS paper, Spiegel and Getzman and Brown, we're talking about. They didn't really say it quite that way, but it's all about trading faster than the return measurement interval. And if you do that, it creates all sorts of problems. You can cause, spurious alphas and fake timing because of the nonlinearity and all kinds of problems. And I call it interim trading bias. And this avoids that, of course, because it doesn't measure the interim trading at all. It just takes a snapshot of the weights at the end of the quarter. And that's all it does. So it doesn't capture that interim trading in any way. Right? Can avoid systematic scale pricing bias, something that I talked about with Young Chen and Alan Peters at the JFE a couple years back. And also, it's interesting because with holdings-based, typically, you measure the holdings and then you measure the underlying stock returns, and everything is on a before-cost basis. So you're trying to measure the ability of a manager before the costs. Whereas in the returns-based measures, typically you have a fund on the left-hand side, and the return is measured net of all the costs. Well, most of the costs. Expense ratio, trading costs, biggies. It's net of those already when you get the data. But then on the right-hand side, you have benchmarks that aren't charged any costs. You got the femme French, high minus low or small minus big, and you have short positions in those things, and they're not charged any cost for that. But in fact, it would cost you something to do that. Right? So it's apples to oranges. And this avoids that. So it has a lot of demand. So that's one reason it's become so popular. Of course, it has disadvantages. The Greenblatt-Tipton measure, as I said, is valid in a very stylized model. Now I'm going to show you in a minute. Essentially it leaves out the risk adjustment. And while it's valid in that stylized model, it's more generally not valid. It has to be fixed. So I'll talk about that. In particular, it leaves out this idea of volatility timing. Jeff Bussey, the RFS, wrote about that and said, had some evidence he thought that fund managers were reacting to market volatility. And if that's going on, we've learned that the Greenblatt-Tipton type measure can be biased by ignoring that. Now let's say more about it in a minute. And also, I think it raises the issue of power. Because you leave out the interim trading, what if managers are doing stuff between reporting dates that really is enhancing performance? Maybe interim trading is a good thing. Why just not measure that? And so you lose power maybe to detect really good performance or bad performance. So for example, the ability to like DFA, the ability to trade at low cost would not be captured here. Right? So it does have some disadvantages. Well, on the power thing, though, there are a couple of papers, and Ken and I did some stuff, and there's this Jang et al. In JFE 2007 that did some simulations on these weight-based measures to try to see how much power, they might give up. And I came away from both of those studies saying, it looks like bringing in the additional information in the weights that you're using is offsetting loss of power from interim trading, essentially. And so the measures are looking in those simulations to be quite powerful. So, but there's only 2 studies that I know of that have ever really looked at that, and I think there's more work to be done to understand the statistical properties of these measures better. I got a student I think is going to start working on it. So see what he teaches me. Okay, conditional weight-based measure. So this is the old stuff, the Ken. And so, what I've done over and over again with great delight is to say, well, wait a minute, what if we condition on public information in an explicit way? So here we have the conditional weight-based measure, which says, all right, the portfolio manager might use public information, Z, they might have better information, omega, and then we're going to look at the covariance of their weights with the unexpected return given the public information. So the idea there is if you can predict what the public doesn't expect with your weights, you have ability, you have information. And it's related to the Greenblatt-Tipton, which is the unconditional weight-based measure, we call it, the green one on the left, there at the bottom. By a simple decomposition, it's equal to the average of the conditional measure plus this term on the right, which is the covariance between what, the weights, or at least what you would expect the weights to be with public information, and what you would expect the returns to be with public information. So that's the public information effect. And the whole idea of the conditional measure is to extract that component from the performance. Right? So if the manager is just doing something that can be done with public information, we're going to say, let's not give them credit. Let's not say this is a smart manager. And they hate that. Right? But that's what the measure does. And it matters. So we did these examples where we made up strategies that traded within the quarter using just public information. Call that interim trading using Z. And we fed that into the original Greenblatt-Tittman measure. We found positive performance with a t-statistic of over 5. Where, of course, in the conditional view, there was no performance there. And then when we fed it into the conditional measure, it wasn't significant anymore. So that's a good thing. But here's where the managers hate this stuff, right? Because if you, Ken was working at Cowan Associates at the time, so it's the universe of managers that they had. And you know how these pension consultants are, is they like to think that, well, we have the good guys here, you know? And so if you use the original Greenblatt-Tittman, you look at, say, the fraction of the funds with positive measures. All funds, 72%, growth funds, value funds, and all funds and growth funds, significant fraction of those managers had good performance under the traditional measure. But with our measure, not so much. They hate that. So it matters. There's all these other measures. You've probably seen some of these. Return gap based on holdings. Active share, how far away are you from the benchmark with your holdings. All very interesting measures. And I think maybe the most famous one these days is DGTW. So if I just told you DGTW, how many people would have known what that was? See, some people would have known. So what it is they take essentially the Greenblatt-Tittman measure, and then they add and subtract all these little pieces. So the sum of the pieces, say, first piece they call characteristic selectivity. It's a piece up there. And then there's the second piece, which is red and blue, they call characteristic timing. And the last piece, they call average selectivity. The clever thing about this measure, I think, is that every stock gets its own benchmark. And the way they do that is they take the universe of stocks and they break them up into the usual cells based on size and look to market and such. And they assign every stock to a cell. And then the portfolio in that cell is that benchmark for that stock. All right? Now the assumption there, if that's an appropriate benchmark for that stock, is that having matching characteristics means you have the same covariance with M, the stochastic discount factor. Right? That's the assumption they're making. Might be right, might be wrong. That is the assumption that they're making. Okay? So you have all these pieces. Now, one thing about this that's kind of interesting is, and I'm going to show you the CS measure in a minute, because that's the one that the literature has used the most. So, I don't want to accuse anybody of sort of specification mining, but you have these measures. The sum of the three is Greenblatt-Tittman. The sum of the three has a theoretical justification, as I described. The separate pieces do not. Okay? And what has happened in the literature, I think, is that people have estimated these pieces, and the only one that was ever significant was the CS. So now we have all these studies that only look at the CS. Problem, no theoretical justification. I said this at dinner to one of my esteemed senior colleagues last night. And he said, yeah, but it's intuitively, plausible. How many things are intuitively plausible and once you get down to be rigorous about it, are wrong. I mean, isn't it our job to do that, to get down to be rigorous and figure out what's right and what's wrong? Anyway, that's a very clever measure. But, so let's go back to first principles. Let's be rigorous about this. How does a manager, I want to say, how should we be doing weight-based measures? How do we do them right? And the first question is, all right, how does a manager actually generate alpha using portfolio weights? I've argued that, from the client's perspective, it's all about alpha, and the right alpha is the stochastic discount factor alpha. So how does a manager use portfolio weights to generate alpha? All right? Well, it's pretty simple. There's the definition of alpha. We plug in the portfolio return based on the weights. We do some algebra. You'll get the bottom line right there. Okay. What it says is alpha is the covariance between the manager's weights and the subsequent values of m times r, summed up across the returns. Now, what is m times r? M times r is the risk-adjusted return. Right? I mean, m times r is a thing whose expectation is always equal to 1. You can't predict the difference between its expected value and 1 if you have public information. That would be abnormal if you could do that. Okay, so you can't predict m times r if you only have public information. But if you have omega, if you have more, maybe you can. That would be alpha. If you have better information, then you can predict the abnormal risk-adjusted returns. Okay? So that's what we should be doing. Okay? We should be doing it, that's not what's been done. Now, Ken and I are guilty of this too, because we didn't do it right. Sad to say. We didn't know this then, but now we do, and so there's a lot of opportunities to start doing it right. We should be doing covariance with risk-adjusted returns. Instead, we've used covariance with returns, which we've estimated by demeaning either the benchmark or the returns, or the weights of the returns. So, all right. So the next question then is, when is it okay? When is the traditional way of doing weight-based measures actually equivalent to doing it the right way with risk-adjusted returns? There are conditions under which it's okay. There must be, because Grunwald and Tittman theoretically proved that there's situations where it's okay. So, a little algebra. When is it okay? So, if you have an appropriate benchmark, you have the blue equation in the upper right. Covariance, which says, covariance of the benchmark with m is the same as covariance of the fund with m. That's the appropriate benchmark. If you do that, you do a little algebra, you see in the middle of the slide that the right alpha, the thing we should be after, is related to the current versions of weight-based measures, which is the term on the right in green. Anybody read green colorblind? Oh, good. My wife thinks I am green. It's wrong. I can see that's green. She won't let me wear green because she says, this green and this, that. Anyway, different story. But the current versions are in green on the right, and they're equivalent to the alpha that we ought to be after on the left if the other terms go away. So when do the other terms go away? Well, I'm going to define the conditions where that's true, and there are 3 necessary conditions listed at the bottom. So if these 3 conditions are satisfied, I'm going to say you have appropriate benchmark weights, which means you've done your weight-based measure where you took, return minus a benchmark and covariance of return minus benchmark, and you have appropriate benchmark weights. So the benchmark, 3 conditions. The benchmark weights have to be such that it's the public expectation of what the manager would do, based on the public information. So if I didn't have any information, what would my manager do? I have to think about that. How do I hypothesize that a manager without information would would trade? Would they do buy and hold? Would they rebalance to fixed weights? Grimbaud Tim would assume the latter. Okay, but you have to think about that. Second condition is the weights have to form an appropriate benchmark, as I defined before. The third condition is that the alpha of the appropriate benchmark has to be 0. So you have to convince yourself that all three of those conditions are true in order to justify doing weight-based measures in the traditional way, including, sadly, what Canada did. So as you can see, there's a lot of work to be done here. So here's an example of trying to do it right. Very simplest example. I want to start with the simplest possible example of trying to do it right. And this is with Hightown Mo, who is here at the FMA, and hopefully he's in a job interview right now. He's on the market this year. And it's very, very simple. So we're going to see the rub here goes back to the wisdom of Gene Fama. And we all know about this when he said, oh, you know, you always have a joint hypothesis. Marginal market equilibrium has to be assumed. And it's kind of funny because the Grimbaud-Tittman paper in 1993, the title was Performance Measurements Without Benchmarks, as if you didn't have to assume a model. Wrong. He knows that now. But you do have to assume a model. The rub is you've got to write down an M to do this stuff right. There's no way around it. Okay? So we're going to write down an M. And we're going to write down the simplest possible M you can think of, which is a linear function of the benchmark. Now, this idea, of course, is going to work with all other kinds of M's, but this is where we're starting. Simplest thing. And this allows to compare more easily with previous measures. So what we're going to do is we're going to have the underlying stocks, and on daily data, they'll have a factor model regression on whatever those benchmark excess returns are in the factor model. And there'll be betas on those, and then we'll build up using the portfolio holdings a set of asset allocation weights. And the way we'll do that is we'll hit on the bottom there, we'll hit the portfolio weights through the regression for all the returns for the portfolio, and then we'll see that X prime beta is the implicit asset allocation weight, the weights to the benchmarks themselves, implied by the betas of those individual stocks. So we'll have asset allocation weights, and we get this a couple different ways. One is to take them right off of CRISP, where they talk about stocks, bonds, and cash, and the other is to do it this way. And then we're going to use the factor model to break up the returns on the stocks, and this is not new. None of this is new, really, into two parts. The systematic part, beta RB, plus the idiosyncratic part, intercept plus residuals. All right, and we're just going to plug all that in to the simple equation for, how do we do this right? Alpha is, right, E of MR prime B. And we get this result here. And so there's three things that sum up to give you the right alpha. And the first thing looks like the Grimbaud-Tittman measure, but it's applied to the asset allocation weights. And we're going to call that, level timing. All right, if there's only one benchmark, the market, we're going to call that market timing. Now, the second piece is kind of a new piece. We call it volatility timing. Harking back to Bussey 99. Very different from what he did, though. Because here, it's the unexpected second moment matrix multiplied by the weights and summed up using the asset allocation weights. So volatility timing. And that gets a negative sign in front of it because if you don't like second moments, you know, you're risk averse, then what happens is you want your manager to go out, get less exposure to the factors before their volatility goes up. All right, so if a manager does that, that covariance is negative, and then it gets a negative sign in front of it, and that contributes positive to alpha if you do that. Okay? Now, this volatility piece is not in the original Grimblatt-Tittman or the DGTW type measures. Because, remember, those measures were developed assuming normality, and they really used the homoscedasticity of the normality in the derivation. So in that model, a manager never gets the signal that volatility is going to change because of the homoscedasticity of the joint normality assumption. Right? So if there is time-varying second moments, and my gosh, I mean, wouldn't the archie-garchie people just be rolling their eyes if I even asked the question? Of course there is. And if managers are responding to that or trying to anticipate volatility changes, those measures that leave that out are going to be misspecified. And especially because, you know, the term you left out might be correlated with the term you had in. You know, so you have this classic bias here as a variable. The last term we call selectivity. And what that is it says X prime B is the portfolio weighted average of the idiosyncratic returns. And if you can do that in a way that's correlated with the stochastic discount factor, people like that. Okay? So that's selectivity. And it relates to this DGTWCS in the following way. If you think of their benchmark in red, which is every security gets its own benchmark, right? As corresponding to our systematic part of each stock return in that regression on the benchmark factors, if you think of that as roughly equivalent, then that difference between the fund and the benchmark is like our X prime V. Okay? So their term is like the first, so our selectivity has two pieces. The A, which is a constant times X prime V, that's like their measure. So theirs is like X prime V, E of X prime V. So ours is like A times sort of their measure. But ours has this extra piece in it, which is this minus B part that they leave out. And what that says is, if there's a second, that's another second moment effect. You could say it's, you know, if the weight is correlated with V times RB, second moment, then that's another piece of selectivity that they left out. Same reason. Okay, they left it out because of the joint normality in the Grimblatt-Tittman measure, of which they are a piece. All right? So if there's second moment things going on, their selectivity measure is screwed up by that. Okay? So here's an example from our paper where we sort funds, in this case on the expense ratios. Now it was Wormer's 2000 that found high expense ratio funds had higher DGTWCS measures. They call it selectivity. It's really just a piece of selectivity, I think. But that's in the back in the gray as you sort from low to high expenses, and you kind of see a hint of what he found. And now our measure and all its pieces are in the various colors in the foreground. And this is sort of summarizes in one slide the basic flavor of what we found in this working paper. And that is, well, first of all, in the red in the foreground is the volatility timing. Now that is completely left out of these previous measures. All right? And it looks like it might play a role. Then we have the level timing in the blue, after that, and the selectivity in the green after that. Then the sum of all that, the total alpha, in the magenta next to the back row. And, you know, and none of that really shows a significant pattern across these sorts. So I think what's happening is you get all these pieces that are offsetting, some of which were left out and the DGTWCS measure. But if you put them all in there, you end up saying that performance is not much performance. You don't see the performance. And we've done, you know what, I think, so I'm almost done. But lately on this working paper, we haven't submitted it yet, I started thinking about multiple comparisons a lot, you know? I mean, how many estimates of performance do we generate in doing this paper? Now, you know, at the 5% level, 5% of those will be significant, even if nothing is going on, right? If we don't account for the fact that we looked at a lot of tests. So we made it a goal to kind of be serious about that. So we counted up the number of times we'd estimated a performance measure. Now here you can see there's a lot of them just in that slide. There's 10, there's 1, 2, 3, there's 50 of them right there. Right? So I made high time go back and add up everyone he ever did for the whole project. 1,158. And way less than 5% show T ratios bigger than 2. All right? So overall, I come away, although there are some patterns that we think, you know, you see, thinking of it that way, you're saying that's if the tests are independent and completely random. And we think there are some patterns maybe in the data that we're talking about in the paper. I won't go through that here. But overall, you know, big picture, the performance seems to go away. But, you know, it's just a start. There are many different things, ways that this can be done, different M's, different kinds of funds. I'd like to see it done on hedge funds. I'd like to see factors in the M that are interesting for hedge funds, like liquidity, options, stuff like that. So here's my summary. The right alpha, stochastic discount factor. In general, I didn't emphasize that here in this talk, but I do in the paper with Jared Chairman Lynn, is in general investor specific. If markets are not complete, and I don't think they are, different clients will have different marginal rates of substitution. They will have different M's. They will have different alphas. Two different clients may have different views on the alpha of the same fund. I think this is a formalization of what sophisticated financial planner types try to do for their clients. So I think that's a place where we can go in this research to try to, you know, we have all these data. If we could go to like Switzerland or someplace where they have all these data about people, we can think about clientele specific alphas. The traditional alphas can be okay. That is equivalent to the stochastic discount factor alpha, but you have to use an appropriate benchmark, which I've defined. Mean-variance sufficient portfolios are almost never appropriate benchmarks, unless you like quadratic utility, which we use it. It's tractable, but we don't really like it. Sharpe ratios, perhaps surprisingly, can be useful. Compare them to an appropriate benchmark, they're okay. Because they're the same thing as the correct alpha. Now, you know, this to me, I think there might be, I'm not a very high-tech guy, as you can tell. Everything here is simple algebra. If I can't do it as, you know, covariances and stuff, it's too hard for me. But there are cases, I think, if for theory types who like to do limits and things like that and continuous time, I think there are cases where you can get Sharpe ratios that are unbounded with certain strategies. And so what that would mean is that the appropriate benchmark would be unbounded too in those settings. And so that would be kind of interesting to think about what it means to compare the two. Current holdings-based approaches, this is where the literature is going. They are flawed because they don't do risk-adjusted returns. The conditions under which what's been done is equivalent to doing it correctly are very, very stringent. And I think you'd almost never be able to look yourself in the mirror and say, I believe those conditions are satisfied. So why not just do it right? I think that's what we need to start doing. And that's what I'm starting to do. So, thanks a lot.